There's no consensus on the 15 causes. What caused the 1987 stock market crash? Nobody actually knows. I got a list of all the different possible causes that people have come up with throughout the years. Now, Black Monday, this is October 19th, 1987. The stock market crash, Black Monday, a day that will live in infamy. You're going to have a 23% drop in value. The Dow Jones Industrial Average is going to drop 508 points. 508 points. 23% drop. This is the worst drop in all history. Worse than the Great Depression, worse than the Great Recession, worse than the lockdown, coronavirus 2020 lockdown. So let's look at the Dow Jones recently. So Donald entered in January. On January 22, 2016, the Dow Jones is at 16,093.51. So, about 16,000. Then it rose. It topped out at January 10th, 2020 at 28,823.77. So what? 29,000. So wow, remarkable, right? Donald Trump's in there at 16,000, and here we are 4 years later, and it's 12,000. It's 13,000. It's raised 13,000, but then it's going to bottom out March 23rd, 2020 at 18,591.93. That's just 2,500 above when Don had entered. It dropped more than 1,000 points. So it topped out at 28,823, and it bottomed out at 18,591. That is more than a 10,000 point drop between just 2 months. 2 months in a couple days. So currently it's at 23,775. So it's back up, right? It's rising. But it dropped 10,000 points, and so therefore, overall, the stock market lost more than 1/3 of its value. That's 35% of its value is lost over the span of 73 days. So you're going to have the Great Depression. It's going to be half of its value is lost with its, top and bottom, half of it. So we only lost 1/3, but, it's basically doing the exact same thing. Now, when it comes to one-day records, nothing competes with 1987. So, in the Great Depression, they had, Black Monday, Black Thursday, and all that, the stock market crash. One-day drop is going to be 13%. So, the worst day of the stock market crash of the Great Depression was 13%. 13%. And it was 12% for 2020. So 12% drop at March 16th. So therefore, what we're doing right now, we're not crashing like the 1987 market crash, but we're crashing like the 1929 New York Stock Exchange Great Depression crash. So, that's some good news, right? Just don't panic. Whatever you do, just don't panic, okay? So 1929, it was 400 points, drops down to 200 points, that's half of its value. 2020, we lost 35% of our value, but we're on the upward gain, so, ignore the IMF and Goldman Sachs, and they're just a bunch of naysayers. What does Goldman Sachs and the IMF know? So the stock market crash in 1987 and subsequent recession, the biggest one-day drop in stock market history, percentage-wise, it's still the reigning champ. 23% drop's insane. The Dow Jones, specifically, is 22.61%. So yeah, we're not crashing like 1987, more like the Great Depression crash. So don't you worry. In 1987, October 19th, this is going to affect not just New York, but London, Hong Kong, Berlin, and Tokyo. They're all going to have crashing stock market exchanges. You're going to see a small recession right after the 1987 crash in America. The Federal Reserve's response set a precedent for central banks' use of liquidity to stem financial crises. The stock market was a bull market for about 5 years prior to the 1987 crash. The Dow peaked August 1987, 2,722 points. 44% over 1986's closing of 1,895 points. So 1987, it rose 43% in value, reached a peak of 2,747 on August 25th, 1987. It continued to stay in a slightly lower trading range until October 2nd. Then the fall happened dramatically. 15% it lost in 2 weeks, leading up to Black Monday. New Zealand stock market is going to drop 60%. New Zealand is going to refuse to loosen their monetary policy, and that's going to have long-term negative consequences. It's going to take years for New Zealand to recover. The Great Depression lasted for 12 years, and it took the stock markets of the Great Depression 25 years to fix after the 1929 major dip to get back to the same numbers that it used to be. It took 25 years. In 2 trading sessions after the 1987 Black Monday New York Stock Exchange 23% dip, the Dow Jones Industrial Average gained back 288 points, or 57%. 2 trading sessions, so what, 2 days? 2 days later, after Black Monday, we're already seeing the stock market recover. And then less than 2 years later, 1989, the U.S. stock markets are going to surpass their pre-crash highs. So it's going to recover completely in 2 years. So 2 trading sessions, you see that it's gaining, right? 288, 57%, major rally and recovery right after the fact. And then by 1989, everything is all back to normal. So the worst crash in American history. It's possible for the stock market to crash, which traditional classical definition doesn't mean that it crashes down to zero, but it crashed because the value dropped 10%. If it drops more than 10%, that's a crash in one day. So it took 2 years for the New York Stock Exchange, the Dow Jones, to get back, all those stocks to get back to normal. It wasn't a Great Recession. It was a tiny little, teensy-tiny recession. It wasn't a depression. It was a recession. So it was here and gone. The recession was here and gone. It was a momentary 1987 recession. So it's totally possible to go through a stock market crash and for it not to touch the factories or the workers or the factories, and it just stays in the financial economy, and it doesn't affect the real economy whatsoever goddamn motherfucking ever. Now, I like what this guy said. I don't totally understand all of it, but let's just go through it. Forced selling causes a crash. He says there's only one thing that causes a stock market to crash, and it's forced selling. Forced selling. Okay? So only forced selling, according to this guy, he says, is the only thing that causes a stock market crash. Luckily, 2/3 of the forced selling that took place was not due to margin calls, and the percentage of the money that was engaged in this forced selling was much bigger than that. Therefore, since the mutual fund sellers and the portfolio insurance players were not unwinding leverage, it didn't turn into an economic event like 1929 and 2008 did. So that he's saying 1987 stock market crash was just the stock market event. It was just a trading event. Had nothing to do with economics or politics, and nothing to do with, anything. Crashes are never caused by poor earnings or lower economic growth. Those things cause recessions and depressions, but they do not cause crashes. One thing, and one thing only, can cause a crash: forced selling. Forced selling is also forced liquidation. Usually entails the involuntary sale of assets or securities to create liquidity in the event of an uncontrollable or unforeseen situation. Forced selling happens in reaction to an economic event, personal life change, company regulation, or a legal order. Within the investing world, if a margin call is issued and the investor is unable to bring their investment up to the minimum requirements, the broker has a right to sell off the positions. Personal finance, individual assets may be liquidated for many reasons, including divorce, death, or bankruptcy. So the 1987 crash didn't have many consequences. A lot of people were freaking out, a lot of panic, depression, oh my God. And they fixed some things. They had the credit circuit breakers now. So they got the circuit breakers, which if you see the market dropping, then they just shut all the trading down. So that actually happened in 2020. This year, you saw a circuit breaker actually get triggered, and so therefore you saw less losses. instead of it just dropping and dropping, everybody just like, you know, watching the thing with their mouths open, but it triggers, you know, because of, they had a program, a computer program. It wasn't just portfolio insurance, but portfolio insurance was something about you hedging by selling futures. So therefore, if you see the market drop 10%, then automatically the computer program would just start selling the futures, and that's like short selling. The whole economy is going down, then they short sell, but then the computer program, a lot of these were doing it, so you had some short selling, then it would reverberate, and then others would, you know, short sell, and then by, you know, after a while, the whole damn thing was short selling. So it made it worse. You had a computer program, which is kind of, you know, remarkable. The computer program was just putting orders out, and it overwhelmed. You actually have literal, you know, people on the floor buying and selling these things, and you have a computer program just dumping all these orders, and it's overwhelming all the brokers that were on the stock market scene. So the portfolio insurance, it's a financial tool, just some bullshit basically, but a way to hedge your bets. If the market starts to go down, then you sell the futures, but then that, you know, makes the economy go down too. Salomon Brothers was 5 times bigger than Goldman Sachs. They invested $2 billion into 30-year Treasury bonds, and short sellers of 30-year Treasury bonds made a fortune because the Salomon Brothers did that. I don't know who the Salomon Brothers were, but they are 5 times bigger than Goldman Sachs. They're not here today. You also had a bunch of, you know, the electronic, the algorithms, so the circuit breakers. Now, today, if stocks dive 7%, trade is suspended for 15 minutes. If the stocks dive 20%, then trading is suspended for the rest of the day. And so, you know, apparently there's relentless rallies. We're not as leveraged now as 87 was, and that's apparently better. But, yeah, I feel like there's a financial economy, there's a real economy. Now, the causes are many and numerous, right? There's portfolio insurance packages, which is a financial instrument, a financial tool, you know, a bunch of financial jargon bullshit that, you know, wind up, a lot of people lost their asses on those portfolio insurance things. And they were caused because they were connected to the computer-generated program that, you know, forced the short selling if the market dropped a percentage. There was a general gut feeling of impending crash. There was just a general sense of malaise and, oh my God, you know, fatalism. There was an asset bubble in the first half of 1987. By late August, the Dow Jones Industrial Average gained 44%. So you just had, you know, a bull market for like 4 or 5 years. And so everybody had too many assets. There's an asset bubble. Who knows? The structural flaws. Stock options and futures markets use different timelines for clearing and settlement of trades, creating the potential for negative trading account balances and, by extension, forced liquidations. Securities exchanges have been powerless to intervene in the face of large volume selling and rapid market declines. CNN and TV news could show the New York Stock Exchange collapse in real time, so the entire world was watching the New York Stock Exchange go down. The securities exchanges have been powerless to intervene in the face of large volume selling, rapid market declines. Portfolio insurance, it's an investment vehicle, right? We talked about high risk, trading risky securities for the entire world's stock exchanges, hedging technique, mitigate risk, limit losses by buying and selling financial instruments, stocks, futures, in relation to the changes in the overall market price rather than the changes in market fundamentals. So it was just based on what the markets were doing, and if it hit a price, then automatically, you know, it was a stop option, stop-go kind of option. You also had a bill, one person said this is the main thing, the anti-mergers and acquisitions bill. You would get tax breaks, these big companies, every time they would do mergers and acquisitions, and get these big-ass tax breaks. So the House, October 13th, introduced this bill, and then October 15th, it's going to pass in the House, and that was just a sort of an air balloon, a test air balloon to see how, you know, the stock market people will feel about it. But in those 3 days, the stock prices fell more than 10%, the largest 3-day drop in 50 years. So October 13th, October 15th, right? So this is just 4 days prior to the Black Monday. So this is the anti-mergers and acquisitions bill. Could have been something that, you know, freaked Wall Street out. They are petulant, petty, prima donna, you know, of the drama queens. So they overreact a lot of times. but there's no more tax breaks, you know, which is kind of, it's anti-monopoly, it's anti-big-ass groups of shit, but these, you know, the people that directly were involved, oh shit, we're doing mergers and acquisitions now, we're not going to get tax breaks, and then therefore, you know, stock prices went down. Leverage buyouts, tax bill reduced tax benefits associated with the finance and mergers, and leveraged buyouts, something to do with the era of Michael Milken, Ivan Boesky, insider trading when it came to mergers and acquisitions. The Department of Commerce reported unexpectedly high trade deficit figures. That hurt the U.S. dollar. The federal government released news of a widening trade deficit. October 15th, the Treasury Secretary, James Baker, said that he's going to let the value of the U.S. dollar fall for the, you know, fuck of it. Well, actually, he was going to make the U.S. dollar cheaper. He devalued the dollar because he wanted to make U.S. stock prices cheaper for foreign investors, many of whom were selling. So Baker, thought that a lower dollar would help reduce the alarming rise in the U.S. trade deficit. So there's a U.S. trade deficit, then James Baker is running his mouth, just talking a bunch of horse shit. Federal government disclosed a larger than expected trade deficit. The dollar fell in value. Digital trading, computerized stock trading programs, right, that was associated with the insurance, the portfolio insurance. So, yeah, they were just overwhelmed. The dealers on the New York Stock Exchange, they're just overwhelmed with all these computer orders. They couldn't find enough buyers for them all. As a result, the stock market halted trading. International investors added to rapid pre-crisis appreciation in stock prices. There's renewed inflation fears. Inflation's, rearing its ugly head. Inflation was wrecking the early 80s. There was rising interest rates, massive trade and budget deficits. Some people blame specifically Dan Rostenkowski. His House Ways and Means Committee are the ones that did that bill, that takeover tax bill that would stop corporate restructurings, mergers, and acquisitions. That was Mrs. O'Leary's cow to the Chicago fire. It was a triggering event. But it was a trading event, not an economic or a fundamental one. Rising interest rates, rise of portfolio insurance. Institutions bought the product, engaged in an agreement to sell short S&P 500 futures if the stock market fell by a certain amount. This would allow them to offset any losses that a meaningful decline would inflict on a portfolio. With portfolio insurance, they are contractually obligated to sell into a falling market due to their portfolio insurance agreements. 1983 market rallied for 4.5 years prior to 1987. So this is, it's going to happen with the Great Depression. You're going to have just basically the roaring 1920s, so this big boom, right? This great, everybody's just hog wild, everything seems great. So for 4 years, stock market was doing really great. So maybe, we've been doing good for 4 years, something's bad around the corner. The computer program-driven models follow the portfolio insurance strategy. Investor panic. Economic growth was slowing. Inflation was rearing its head. Valuations climbed to excessive levels, with overall market's price-earnings ratio climbing to over 20. Future estimates for earnings were trending lower. In the Plaza Accord of 1985, under the Plaza Accord of 1985, the Federal Reserve agreed with the central banks of the G5 nations, France, Germany, United Kingdom, and Japan, to depreciate the U.S. dollar in international currency markets in order to control mounting U.S. trade deficits. There is no fucking reason we should ever just say, you know what, let's depreciate, devalue the U.S. dollar. The U.S. dollar's got to stay strong and reliable, and we got to make sure it's hard, strong, good, honest to God, good, decent currency for, legal tender for all purposes. We need to make sure the dollar stays strong. We should never devalue the dollar. And so, yeah, there's, 15 or more so reasons for the 1987 stock market crash. The market fundamentals, it's financial statements, looking at people's assets, liabilities, their earnings, the health of the company, competitors and markets, overall economy, interest rates, production, earnings, employment, GDP, housing, manufacturing, management. So market fundamentals, just get to the fundamentals, right? You got producers, you got consumers, you got supply, you got demand, market fundamentals. assets, liabilities, production, GDP, whatever, housing. So the Fed, they're going to be the saviors. This is Alan Greenspan in 1987. He's going to come back again, right, with Baby Bush. But back in 1987, he was the Federal Reserve Chairman, and consistent with its responsibilities as the nation's central bank, it went ahead and affirmed today its readiness to serve as a source of liquidity to support the economic and financial system. Let's see, Ed told banks to continue to lend on their normal terms. Alan Greenspan, I don't know, the Fed, Bernanke said that the 10 largest New York banks nearly doubled their lending to security firms during the week of October 19th, even though the discount window borrowings didn't themselves increase. So, yeah, the Fed, rushed in long-term fixes because of the 1987 stock market crash. They went ahead and developed brand new rules called circuit breakers, and that allows for the stock market exchanges, such as the New York Stock Exchange, to stop trading temporarily or for the entire day in instances of exceptionally large price declines. For example, right now the New York Stock Exchange will halt trading when the S&P 500 stock index declines 7%, 13%, and 20% in order to provide investors the ability to make informed choices during periods of high market volatility. Risk managers recalibrated the way they valued options. Regulators overhauled trade clearing protocols to bring uniformity to all prominent market products. So they fixed some shit, right? And those circuit breakers was actually used, in 2020. So because of the 1987 stock market crash, we have circuit breakers now. So therefore, it, even though it dropped, 12%, and it's dropping like, insane rates, it's not looking like it's going to drop all the way to the bottom, immediately. Now, I want to make a quick couple points just about stock markets. So when there's a stock market crash, it doesn't mean the whole economy collapses. You know what the hell those gamblers do up in New York? So a couple people gambled on Wall Street and lost their shirt. Fuck them. I mean, what the hell? That's the 10%. The wealthy people, most of the people that own stocks are the richest people. So you might have some middle class, upper middle class assholes who's, into the stock market and shit. Maybe even poor people might be in the stock market. But ultimately, it's a rich person's game. And the middle class people, if they can, put money on the stock, they got that much disposable income they could just play, goddamn Russian roulette with their money on the stock market. That's way more money than, I ever have had and probably will ever have. And so we're in different, classes altogether. So stock market crash, it makes me think when it crashes down to zero. But when I think about a farmer's market crash, if the farmers always came to a spot and they traded their goods, you always have that market. The market is just what the space that you need to trade. That's all the market actually is. You get to, exchange money for goods and services. That has to happen. So whatever contracts and whatever it takes in order to do that. But, the farmer's market, you got the goods from the farmers being sold to the public. What would it take for the farmer's market to crash? Even a hurricane can knock out all the structures, but they could still congregate there. So the space is, the most important thing. And a hurricane, that would be a crash, right, if there was actual literal, property damage. That's a real crash. But just because one day their potatoes, didn't sell and they didn't make any money, oh shit, the whole thing's crashed. I don't know. There's definitely a major difference between a financial economy, those bullshit things that they are doing, and the real economy. So stock market crash, their definition is a dramatic decline of stock prices across the cross-section of the stock market resulting in the loss of paper wealth. But crash just makes it sound like it's crashed and dead and gone, not just it dropped 10%. Right? That's great propaganda. If you think about 1929, when I think about the 1929 Great Depression, it started with the stock market, right? That's the propaganda. But that's perfect for Wall Street to make it seem like if Wall Street dies, then you're going to die. That's perfect propaganda. That's great mentality for Wall Street. And, to get everybody, even people not a part of Wall Street, to get the common people to attach their dreams and aspirations and solidarity to you. Oh, shit, I don't have any money in Wall Street, and I don't know anybody else that has money in Wall Street. But Wall Street just collapsed, and now I'm worried the whole economy is going to collapse because, you know, the history of the Great Depression. So they want you to think like that. They want you, but you know, they make it sound like you need Wall Street, but they don't need you, right? What happens to the American people when the 45,000 American people die of no health care? Oh, you had no health care, 45,000 American people died. So a market, right? New York Stock Exchange, let's say the market's just wiped out. That's not a person dying. That's not a death. The bankers might commit suicide because they don't want to live the life of, you know, 15% of the American people that are in poverty today. Oh, shit, I don't want to be a poor person in America. But the market doesn't actually, nobody dies with the market if the market deteriorated. 45,000 American people die with no health care per year. Does Wall Street die? So we're supposed to, our interest is supposed to be tied to Wall Street, but Wall Street doesn't tie their interest to ours. Ronald Reagan said productivity is up, manufacturing product is up, no runaway inflation as there was in the past. Nobody should panic. Why are you panicking? Nobody should panic. Oh my God. We're going to need to run $200 billion deficits, guys. This is turning out bad. Stock market crashed 508 points. Down from 2,200, 23% of the value. Stock market's gone. But it didn't go to a great recession or a great depression. The factories kept on producing. The workers kept on working in spite of the 1987 stock market crash. Because they can, of course they can. Some rich asshole on Wall Street lost their shirt. And some asshole in New York gambled and lost their money. Most of America wasn't affected directly by the stock market. Most of America isn't directly affected by the stock market. So therefore, they can only feel the reverberations. Of course, Wall Street wants America to feel if they fail, then we're all going to fail. But from my standpoint, even from a capitalistic standpoint, you know, but a poor peasant, no stocks, Wall Street crashing makes it go all, you know, back to zero. That's just like in Fight Club, right? You get rid of the credit card companies, it goes all back to zero, evens out the playing field, and makes it fair, allows for equal opportunity. You can get back in there, invest it, you know, everybody, it's all the same. Big banks crashing hurts the, you know, big banks, the millionaires, the billionaires, but the Great Depression made Joe Kennedy rich as fuck. A sliver of the wealthy become rich off of depression. So depressions are opportunities for an economic system of a nation to reset itself. I mean, I think it's more scary that we would even consider propping up zombie banks and corporations. A bunch of corrupt, you know, shitty banks and corporations that's offering products and services that nobody wants. So they failed. They, you know, organized them terribly. So let terrible banks and companies fail. That's a good. All these things are good for me. Now, if we had people's banks and people's corporations and people's co-ops, we could get those started. But if they were failing, that would freak me out. But in terms of capitalism, you know, some sink, some swim. You didn't do a good job. You failed. Now let's get some new blood. Let's say the airline industry. Even if that company fails, those airplanes and those runways, all that equipment, those buildings, all that capital is still there. Just because a corporation is just a file, you know, a piece of paper in a filing cabinet. We're going to spend billions of dollars to save a piece of paper in a filing cabinet? Let them zombie corporations die. That one hedge fund manager guy's right. They don't want a second, you know, house in the Hamptons. So there's no direct causal linkage between New York Stock Exchange crash and then the rest of the 90% of the nation who doesn't own anything in those stocks, don't invest in Wall Street. You got some things, you know, student interest, credit card interest rates, and mortgage interest rates. A lot of this is related. Sure, those bankers are going to lose money, perhaps those around them, but just like the 1796 panic, a lot of the people in the rural interior were insulated from the money games of the New England banksters, the bullshit financiers. So they didn't get in, you know, caught up in their stocks and bonds and, you know, liquidity and this and that. A few, you know, derivatives and credit default swaps. A few gamblers fucked up in New York City, you know, New York Stock Exchange. So what? That shouldn't fuck up. You know, people fuck up. Lots of gamblers go to Las Vegas and fuck up. That doesn't ruin the entire country. So a bunch of gamblers in New York City shouldn't ruin the country either. We're 350 million strong. Let the bankers fail. Give their controls to the homeless. Let Quasimodo be kings for a year. Get regular working folks in, you know, these positions of power. Let working class people grab a hold of the levers of power. These Harvard-educated banksters haven't